Hi, this is Randy Finney with the right side of the chart, and today is Thursday, October 27th, 2022. It is 2:31 p.m. Eastern Time as I'm starting the video, and today is the big day by far. Not just the biggest week of earnings for the whole season, but probably definitely the single biggest day. You have Apple and Amazon. So when you add up market cap, Apple, of course, being the big dog, biggest in all the indexes at $2.5 trillion. They're going to report today one of the strongest charts, or one of the best relative performers throughout the bear market so far from the big FANG sector. And so about the only guarantee we have today, we're going to see some movement in the market after today. So far, 3 down, 2 to go. We know what happened with Alphabet, Microsoft, and Facebook. All just smacked down hard, mostly, some more than others after earnings. Maybe I'll get to those charts. But here's the gist of this video. I want to just cover a very brief update on Treasury bonds. That's primarily a swing or trend trade that I've laid out, and again, still to me has one of the best RRs. But when there's those opportunities to for an active trader to either book profits, or maybe somebody looking, you're scaling in, you don't want to really add at resistance. So there's 2 takeaways that post I gave you this morning when with these treasuries at resistance and expecting a reaction. I define a reaction as when you're going up, when a security is going up into resistance. A reaction is either a consolidation on that level or a pullback. And I'm not sure which one we're going to get. I can tell you for the last several days here, the bid has been very strong. Whether right or wrong, predicted leading up to that big FOMC meeting next week, you're going to see some short covering. I can imagine those, especially, it's usually institutional traders trading bonds to begin with. They're the quote-unquote smart money. And hopefully they're smart enough not to gamble and get caught on the wrong side of a short squeeze. So I imagine that's one of the reasons. And there's also been this shift, whether it's just wishful thinking or so, between just the general public, the investing public, pros and amateurs alike, that the Fed's going to ease up a little bit and maybe not be so harsh on their verbiage, so hawkish, if you will. They might pivot a little bit. So we'll see. They haven't. That can be a dangerous assumption, and I can tell you this right now. Whereas, me, a week or so ago, I was adamant that things were going to break. Actually, I've been saying that for a few months, and they started to break. And so, again, I think what we're seeing here is what I figured we'd see is an abatement in yields, which means a rise in Treasury bond prices because of that, knowing that the Fed cannot push the needle, keep it redlined so long. So now, where we go from here, it's going to be a crapshoot and leading into Wednesday. So just like today, if you are very aggressively long or aggressively short, you're either going to be very happy or very sad after today. And what probably is going to happen, what usually happens, is there's a knee-jerk reaction when these big companies report. Market goes one way or the other. They'll clip your stops. So as a general rule, if I am swing trading, if I haven't completely closed out my index longs or related positions that are going to track with the markets, one of the things I'll usually do is, if I don't close things out altogether, I take, lighten up, and I also temporarily suspend stops, and I leave price targets in place. Now, again, that's specific to every trade. They're all different, but generally I do that. And what I mean by that is, let's say I have let's say I was long, and this was a stock here, and this was my next target right here. We popped that level today, and then let's say my stop was right here, just below it. I might temporarily pull that stop. I'll leave the profit target, the sell limit order in place, because my whole goal in any trade, obviously, is to hit my price target and get out and lock in a gain, right? And not to be stopped out. Now, pulling stops can cut both ways, but the reason I'll pull it is if it's just a little knee-jerk reaction, it's going to clip the stop and go on to hit my position. I don't want to be stopped out. Now, of course, when you pull stops, it is a lack of discipline, and that can lead to even bigger losses, of course. And so, again, I'm generally speaking, what I like to do with individual stocks, futures, depends again on the security where I'm at. But especially if I'm close to a price target, I'm going to leave that there and hope that post, whether it's earnings in this case or an FOMC meeting that's in next week, I'll try to use that volatility to my advantage, but not against me. All right, so the post I got, I'm just going to go over these bond charts real quick, and then I want to show you the sectors in the S&P 500. I have something interesting to show you here. So this is ZF, the 5-year. I'll just go through the bonds real quick. That is bullish. There's the breakout. You had the smaller wedge there, the minor downtrend line. Breakout back test. Then we went on, we took out the 106, 151 resistance. Then we broke out of the primary, longer term. Remember, this is a 6-month chart right here. It goes back 6 months in time, 120-minute candles, or aka 2-hour candles. And so all bullish, nothing but bullish there so far. But this was from a couple weeks back. I laid out as the first target 107.060. That was hit with a slight overshoot. There's a previous reaction high there you can see closely. Here, let me step it down for you. That's what I wanted to do for those of you in this in the Treasury bond trades or following it, considering it. This is a zoomed down version here. This is a 3-month 60-minute candle or hourly candlestick. So you can see the same thing there. That was the minor trend line that I had on that other chart, breakout backtest. And so there was a previous reaction high right here. This is more of a resistance zone when I step down to this level. You have a zone from about 107, 124 to 107.069, and we hit the top of that. And so, and you have also negative divergence. So although I really like this trade, I reversed it. I plan to be back in it. Again, that's just me as an active trader. Reversing means closing along, going to short, but only looking for a very short-term pullback, which I'm almost there. I'm going to show you my targets, and I may, before the close today, swap out, and even if they don't hit those minimum pullback targets. But so we'll step it down. I'll show you some of these. I mocked up a short-term chart. Now, this one would have been the 5-minute chart. There it is. All right, so when you look very close, go down to a 5-minute chart. It's just showing you what's happened today pretty much. There was that ramp up into that target, and then we had this a nice clean uptrend line right there as well, and a small wedge on the 5-minute with negative divergence as well. And we pulled back, and that's my minimum target. It's already been hit, but I'm expecting we may get down all the way here to 106, 297. But again, if we don't hit it before the FOMC announcement next week, it's going to be a risk to have a large position in Treasuries once that's out of the way. And again, I still maintain my longer term targets. I'll flip back to those real quick. But there's a little downtrend line which could get taken out. So we have minor support here. If they pop that, that may be it. Like I said, I've noticed for the last few days, any type of short-term breakdowns, even short-term trendline breaks, usually get bought back up quickly for the reasons I said before. Number one, first and foremost, the charts are very constructive. Positive divergences, trendline breaks, all the check marks you need, close to a 10 on a scale 1 to 10. Obviously, they're still in a primary downtrend. Treasuries are, and you still have the headwinds of the Fed quantitative tightening. But again, how much of that's already been priced in, and these bonds are hitting levels now that just from a pure valuation perspective, the yields on these bonds are very attractive, or a lot more attractive than they were a few months ago. And so you're going to have pension funds and the likes stepping in and starting to increase their allocation of bonds, and they have to increase it anyways, because as the price of bonds fall, we're down double digits in treasuries this year, and let's say you run a 60-40 model in your CalPERS pension plan, 40% 60 equities, 40 fixed income. Well, if that fixed income portion drops, you have to reallocate. Obviously, it's all relative to the stock portion and all that other stuff, but anyway, so that's the case. So we're in a near-term uptrend. There's your kind of micro zoomed in targets. Let me go to the 10-year real quick. Same chart I gave you this morning, the 6-month 120-minute candles right here. There's your positive divergence, aka bullish divergence at the low. Nice strong reversal. Very solid uptrend so far. But again, nothing goes up forever. That was a target there. Price resistance 111.214. Pretty good resistance. So we hit it with just a hair of a momentum fueled overshoot. And again, just like the 5-year, we're right at, when I step it down, you can see right at that previous reaction high right here. There's a previous reaction high. So it's more of a resistance zone. There it is. And we're right there now. And negative divergence, just like you have on the 5-year I just showed you. And then you step it all the way down, go to a 5-minute chart. You can see same thing, a little small divergent high. and these charts very similar. You just have a little more price movement in the longer term bonds. The 10 year is going to move more typically than the 5 year. And the 30 year is going to move more than the 10 year. But here's an uptrend line we could come and visit. And max pullback target would be either this downtrend line, a little back test of that, or around those highs right now. If it gets really ugly, that would be your next support down there. I'm going to put a line there for you just in case. Again, I think we'll be able to, at least I will, get back into a heavy full position, long position after the Fed's out of the way, where I see things are. Hopefully, unless I get denied an entry, let's say there's an explosive rally afterwards, and I'm just not comfortable adding at that point. I'll just sit back and wait for a pullback, which may or may not come. So nothing's changed on my longer term targets. I just need to. Probably should have said that early on. I still think we've got quite a bit more upside. This is where I'm looking at on Treasuries. So quite a bit more upside, and it's just a matter of, we're going to pull back a little deeper before then, do something like that, maybe put a little inverse head and shoulders pattern, pop that, run up there. That's it. So that's my max pullback target right there. I think that's the error I gave you today on the scenario. And again, I should have clarified that's a maximum pullback target, 110, about 110, 200, and maybe less than that, because again, a lot of trapped short sellers that are just getting squeezed out now and looking to buy every little dip. Worried about what the Fed may say next week. And then the long bond, you get more bang for your buck when you go out the longer maturities. Cuts both ways. It just means they're more volatile, more sensitive to changes in interest rates, real or perceived. That's how the Treasury bond market works. It's not, if you're new to this, the 10-year bond has very little to do with what the Fed is going to do as far as the federal funds rate, the rate that they announce when they talk about rate cuts and rate hikes. That's the short term. That's an overnight lending rate, literally a 1 day, 24-hour or so interest rate. These are 30-year rates locked in for 30 years. Night and day difference. Now, the Fed obviously quantitative tightening, and just based on what they do, the market tends to react. But again, a quarter point or a half point or a three-quarter point hike in the short-term federal funds rate shouldn't really have any direct impact. These rates are set by auction at market. Obviously, the Fed's been a big seller lately, reversing from quantitative easing back here to quantitative tightening, meaning selling. This is where they were buying bonds, and now they're selling bonds. But same story. You're at dual. You had a little near-term minor downtrend line there, and you have the longer-term primary downtrend line there. You ran into it, so again, as I said, reaction's likely, and that's 6 month 2-hour candles. You go down to 3 month, you can see a little clearer on the hourly, and then you step it down all the way to today, and you can see, boom, this is when I get the post out to you. It was right at the highs today, and there's a pullback already. So if you're an active trader, you sidestepped a loss on your long position, or you turned around and actually closed longs and profited from a pullback. Again, the pullback probably be minor. That's the minimum right there. On the long bond ZB, and of course, if you're trading ETFs, these videos, as long as I run these videos now, as long as they go, they'd be infinitely longer if I covered every variation of every proxy to trade something. A proxy is for the NASDAQ 100. That's an index. You can't buy the NASDAQ 100. You buy proxies or derivatives that track it, and that is QQQ, which is the ETF, or QID, the 2-time short, QLD, the 2-time long, SQQQ, the 3-time short, and then there's futures, and then there's the E-mini contracts, and the regular the E-minis, and then the micros, and then you can have other derivatives or options. Okay, so you get the point. Trade what you want to trade. I'm going over what I'm immersed in, since I largely trade the futures. That's the chart I'm going to cover. But the same, if you track these, you don't even have to trade futures. You can trade TLT, the 30-year bond ETF, or the leveraged versions of it. You just use these charts and look for the support and resistance levels, and to time your entries. In most cases, the trend lines will align as well, especially on the daily chart. Not so much on these short-term charts, because these futures trade just like stock futures virtually around the clock, where the ETFs stop trading. You're going to see the 9:30 to 4 p.m. trades on TLT and things like that. And there's your levels. I'm just giving you micro levels if you are an active trader. I know kind of from the just to the comments that most I don't get a lot of over the years. I just don't get a lot of comments and questions on treasuries and a lot of the obscure things I trade, sugar or whatever else it is. People love, for some reason, to trade the stock market, love to trade stocks. They love to trade the tech stocks and Apple and gold and crypto, the mainstream stuff. To me, if it has a ticker and I can and chart it and it trades well to the technicals, I don't care what it is. I'll trade it because my goal is to make money, not to boast at cocktail parties that I've bought crypto or Bitcoin today. So in treasury bonds, again, I'd say they're boring to some and they don't move as much as the stock market, but therefore that allows you to take a much larger position. So you get a 3% move in treasuries. If you have 4 times what you'd have in the stock market or in a stock index fund, then guess what? You just made comparable to a 12% bounce in the NASDAQ 100 by having 4 times as much. Okay, enough on treasuries. There it is. You have this uptrend line here. There was a little volatility sliced through it, but it's still coming into play right here. Take that out, 121, 242. If that gets taken out, these are all, again, potential pullback targets near term. Very short-term stuff. It's a 5-minute chart, 121.093, and then max pullback target at this point in time. Again, charts are dynamic, and so is my analysis. So if I say at this point in time, I could be, we could be heading down there next week or tomorrow, and I may change that. But as of now, that would be the maximum. I don't even know if we're going to get down that far, but certainly possible. I could easily see it based on, short-term technicals. And that's 120.217 to 120.169. Okay, and now the stuff that just about everybody seems to enjoy trading, and that would be the NASDAQ 100 or the stock market. And these are levels I laid out, and it's been, 2 weeks now? Laid out, these purple lines haven't changed, and we've just been ping-ponging between them. Bearish crossovers, too, I pointed out. You get a bearish crossover, you tend to get some downside after that. This one's been pretty good since the signal triggered right about here, right there recently. But you can see that we danced around this support a little bit, but we took it out this morning. Basically just back tested. We had a little rally there, and we're heading up to the next support level. But again, Apple's reporting tonight, and this is what we're seeing. I talked about it. So, it's like a poker game. The FANGs have started to show their hand. Now, Apple doesn't sell and have the same exact business model that Meta has or Amazon. I'm sorry, Amazon hasn't reported, or Alphabet. Or Microsoft, but these guys tend to move together. They're part of pretty much big tech, they call them, and their profits tend to ebb and flow with the economic cycle. They're growth stocks, and so we know what happened to the first 3 of the 5, and so there's obviously some nervous selling right now in anticipation that Apple and or Amazon might not post what people want to hear and see. But I could tell you we're coming up on support. PPO is still above that purple line. The trend is, that trend indicator is bullish. There's a bunch of mixed signals. Let's not read too much into this. Let's wait and see what happens after they report today. Those are your levels, and I'm going to get to the kind of the bigger picture stuff here in just 1 second. Short-term 5-minute chart, you have a little divergence. Shows better. Let me show you the futures real quick, and then I'll move on and wrap the video up with what I wanted to show you. This is a 60-minute chart of NQ, the NASDAQ 100 futures. I'm going to pull it in nice and tight. I know in the video you can't see when I'm zoomed out like that. There's a support level we're on right now. That's a reaction high there. There's a couple reactions from above right there. Some more reactions there with support reactions from above, and we've been dancing on it, starting to crack. I don't know. Today, again, it's just whether we're going to crack it and go down to the next level before Apple reports or we're going to bounce. I'm favoring a bounce into the close. I think there's probably a little bit, just the day traders are probably shorting this market today on the heels of the other week earnings report from the first 3 that reported. But when you get too many shorts in, the algos will usually squeeze them out. I don't know, guys. It's a short-term thing, but here's what I can tell you with certainty. I pointed this. We had a bearish rising wedge on the 60-minute right there. Bearish rising wedge with negative divergence. It broke down. We back tested the wedge from below, and we've been moving lower. And so that in itself is bearish. But let me give you a bigger picture look at the market here. And before I get to the bigger picture, let me just show you the very small picture. I actually stepped down to a 10-minute chart. So you've got divergence here on the 10-minute. You know, I like to trade these little 10-minute divergent lows and highs. Now, the nervousness in front of Apple may override the very short-term charts. So I'm kind of with a grain of salt. I threw on a long position right before the video because this is a decent support level. I don't know if you can see. It's a line I've had here. It's at 11,234. We fell to that support with positive divergence on both this 10 and the 5-minute chart. So I suspect, like I said, the algos, the market makers, the nefarious forces will probably squeeze those that are short right now out, get a little intraday pop. Probably no more than this. That's all I'd be looking for, up to about 11,355 almost right there. That's it. And if they dump it into the close, that's it. I'm going to keep stops not super tight, but right here a little bit, about a third of the way down to that next support level. All right, last thing I want to do is go over the sectors in the S&P 500 and talk about kind of the bigger picture in the market. Okay, about the biggest picture I usually go to is a monthly chart, monthly candles that is, and it goes back for decades, and we can roll back as long as you want to. And talked about it a million one times if you've been following me for a while. One of my favorite long-term indicators is the 20-period exponential moving average on a monthly chart. It's this blue line. It does just a phenomenal job of defining bull and bear trends. You buy pullbacks to it. All that really matters is a candlestick monthly close below it, and you had zero whipsaws throughout that was one of the biggest bull markets in history, especially in the NASDAQ from the mid 90s up until that was the dot-com bubble. Huge gains. You got your first candle, and it wasn't a iffy candle. It was a solid red monthly close down below there shortly after that bull market had ended and the bear market started. That was an 80-something% drop in the NASDAQ. It got you out right there, and it told you to get back in there. And then it told you throughout the next bull market, which this was, buy all the pullbacks to the 20-month. And then when the Great Recession hit, it doesn't look like much because that one was so big in scope. But that was the 55% drop from October 07 to 08 lows, and you took it out there. There was your first monthly close below it. You had one whipsaw recovery. Nothing's perfect. Only one green candle that printed a close above it. So even if you followed it religiously, you covered your shorts, and then you got back in the following month when it went below, back tested from there. I don't know if you can see that in the video, but that's what it did. And then boom. So it kept you short or out of the market long throughout almost all of that bear market there. And then we entered what will go down in history is probably one of, if not the strongest bull market in history, a la the Fed with easy money. This was when they started their whole money printing party back in 08, and it just kept it going. Figured why not just keep printing, and we'll just prevent all recessions and corrections. Every time the market goes down, we'll just print more money and take rates lower again. And have more quantitative easing. And then they realized finally, ruh-roh, can't do that. Milton Friedman was right. All these economists, if you print money, you're going to get inflation. So now that genie's out of the bottle there, and so we know where we're at. Okay, but where am I talking about? What am I talking about here? Look at it. All those little blips through there were just intra-month and to close right back above it. So again, one of the most effective indicators, and it's told us right here, as pointed out at the time, we had a solid monthly close back there, the month of ending in April, right? And that said, hey, we've entered a new bear market. And every time you go back to it, those are objective shorting ops, so they confirm that you're still in there. It got rejected from below. Tried it again, that was the month of August, got rejected, closed back below it at the end of the month, and we've been moving lower. So we're in a bear market by this metric, all right? And not even close to being out of the bear market. As such, you have to be skeptical of bear market rallies. Bear market rallies look good, they feel good, they're fun to trade, they're profitable to trade, but I'm going to show you some metrics that tell you that this may just be a bear market rally. Now, yes, I've pointed out all these positive divergences and bullish developments recently. In that case, it can still be made. And I'll tell you, Apple and Amazon collectively have the potential to firm up this bullish case or to foil it. Okay, and then of course you have the Fed on Wednesday of next week, and by then this market will have picked a direction. But let me just show you what I wanted to say here. So you know my upside targets if these lows hold, and you also know my next downside target. If you don't, that's it. I've had this target all year. T4 is my what I call my final near-term bear market target. I think we're going to be in a longer secular bear market. So even if and when we hit that, if we hit it soon, probably rally off there. Well, again, it depends what the charts look like, but I still, over time, in the coming months to years, I think we're going considerably lower. But again, that's just kind of, we'll call it not near term, but more intermediate term stuff here. All right, I wanted to show you this. Here's a daily chart. So again, right now, it's been, since these first three fangs reported, they certainly knocked a little wind out of the rally, but they didn't do any technical damage. When we rallied, this is a daily chart, up to resistance. The positive divergence is still in place. So there's still certainly a case to be made we can do this, right? And rally up and test those 200-day moving averages and the downtrend lines on QQQ and SPY. You also have a nice clean downtrend line off the high in the S&P 500. That's right here. And if that's hit, it would be a natural, a very easy, logical bear market target, and it's still another 8-9% above where we're at, and the 200 days are a little above that. Or just like back in '08, I gave you that analog where we had the same positive divergence at the same point, and the same amount of time into that bear market, the same percentage drop off the highs, the same percentage bear market rally that started to confirm those divergences, and then boom, the bottom fell out. So we'll know soon. Hopefully, we'll know soon. Now, let me show you something. Okay, so let's say if you're new to this, I can tell you, we've all been there. A rally like this. Let me go back to more so to the Nasdaq 100. A rally like this feels bullish. When you go up, mostly green candles up until the other day, about a 12% rally, and all the little dips are getting bought. It feels bullish, but that's feeling bullish is subjective or qualitative. Let me show you some quantitative metrics that show that right now this is nothing more than a bear market rally. Now that can change, and I'll show you where it changes from a quantitative perspective. That's what scientists will go by, and that's what technicians will go by. Not how how bullish or bearish a rally feels, but when does it start changing the technicals? So early signs are trendline breaks above key resistance levels, things like that. That's certainly quantitative. And then the other thing, we're going to look and play with fibs today. Fibonacci retracement levels. So I'm going to turn on these lines. So this rally from the lows, let me get to my, nope, I wanted to be over here. There it is. Okay, so what we're going to just look at, and I'll wrap this up quick. Now we're going to go through 11 sectors after going through the market. But these are Fibonacci retracement levels. And to take Fibonacci, what I'm doing is looking at just this counter trend bounce at 12% or so rally, and I'm putting fibs to the last key reaction high. You can put fibs off the all-time high. You can have fibs off each reaction high and look for Fibonacci clusters. And a typical, during a bullish trend, a typical pullback goes anywhere from the 38.2 down to about the 61.8 Fibonacci retracement level, meaning it retraces about a third to almost 2/3 of the previous move, right? And therefore, likewise, in a bear market or a downtrend, a counter trend rally bounce will go anywhere from that 38.2 up to about the 61.8. It's not set in stone. There are other key Fibonacci levels that come in, 78.6, 23 point something down there. But these are the main ones, and from my experience, this is where these counter trend rallies almost always go. So you can see what I did. There's the previous peak high in mid-August right there, the recent lows in mid-October. To the button, a perfect rally into the 38.2, followed by so far a pretty impulsive rejection. So as of now, as of at least just this metric, this is nothing, or was. I can even use past tense right now. was nothing more than a bear market rally. That really becomes technically more accurate once we take out the previous lows. Then that whole rally's been negated. Right now it could just be a corrective phase in the rally. Okay, but I did want to point that out. And where I'm going to go, I'm going to show you now there's 11 sectors in the S&P 500. I'm going to go all 11. I'm going to do it pretty quick. And I think it's pretty compelling what I'm about to show you. All right, so of the 11 sectors, the largest is the tech sector, XLK, and something happened here. Let me switch boards. There it is. So here's again, I'm only going to look at the this most recent leg down, and look at the retracement. There it is. So from that high in mid-August, you can see here, almost perfect, but overshot it by a hair, but close enough for government work. There's a 38.2% retracement, followed by a rejection. So, and that, by the way, is a minimal. Again, it's not set in stone kind of thing. It's just my range, that 38.2 up to 61.8. Most people use that. So far, it's considered a relatively weak counter trend rally, and if that's all it proves to be, then we're still well in bear market territory. And again, you're going to know if we go down and we take out the low, then you'll say in hindsight that this run up to the 38.2, although it was 12%, although it certainly might have felt bullish to some, it was nothing more than a run-of-the-mill counter trend rally and a larger primary downtrend. Okay, so that's tech. Healthcare, XLV. What I've done with XLV, because, well, I'll show you. I'm looking at the all-time high because some sectors have held up a lot better than tech. So on tech, we're in a clear downtrend. XLV is more of a sector. If you look back here, it's been topping. So I'm treating fibs a little bit different. This one's still, if you look at in a bull market, because you're only right now on XLV on the healthcare sector, from the all-time high, you're only down 8%, right? So I'm using that fib right there and showing you that we've got rejected so far, stopped. Really not much of rejection, but we've stopped right at the 50%. Now, I can also do this. We can look at the last rally. Now we know we're going to be over 50% because it's bounced pretty good, but then we can turn on the other fibs, and next one here would be that 78.6, and boom, right there. That 78.6, by the way, here's where it comes in. 78.6% lines up perfectly with the 50%. So that's a fib cluster. If I put them both up, they're both going to come in exactly there, right where we overshot and where we got rejected today. So interesting stuff, at least I think so. XLF, financial sector. That one again from this most recent reaction high right here, 61.8. There's your fib. I'll have to read them out. Unfortunately, I can't make these any larger, the icon size in this on this charting software, but there's your fib measurement, last leg down, almost a perfect 61.8% rally. So this is so far sector number 3 that's at a key Fibonacci retracement level. XLC, communication sector. There's the most recent high, perfect rally right into the 38.2% Fibonacci retracement, followed by an impulsive rejection so far. All right, next up, XLY. And again, I'm going through these in order of market cap or their weighting in the S&P 500. XLY, consumer discretionary. So far, it's fallen shy. It hasn't even retraced 38.2 yet. Very close to that. So I just want to mention we're in very close proximity to that fib retracement. XLI, these are the industrials right here. Move these lines around. From that most recent mid-August high, you've retraced. You're coming up. You're a little shy of the 61.8, and this one's been holding up better than tech. If I look at the all-time high right there when the sector topped, then you are right now at the 38.2. So by that metric, also just a bear market rally. Again, positive divergence. I can make both cases. And just because we're at resistance or at key fib levels doesn't mean we have to reverse, but it does mean if we do reverse here and we start moving lower and continue lower, it is telling us that these were probably or most likely, and we'll know only in hindsight definitively, but at this point in time, all they are is bear market rallies because none of these so far have exceeded the 61.8. XLP to the button. There's the high right there where I measured at the mid-August high down to the low. right at, this is the 50% Fibonacci retracement. So the consumer staples have retraced half of the last leg down, and so far a perfect. There's another fib cluster. Again, by fib cluster, you put up these fib lines. There was the one I just had it on. You do this, and you can see, yeah, I'm not zeroing it in there close enough. You have both the 50% retracement of this last move down and the 38.2% retracement of the entire move down in the bear market. And fib traders look at these. I look at these. Fibs are not my exclusive trading vehicle. It's one of many tools, but they are invaluable. And all I can tell you is, like any other indicator and technical analysis, they are not 100%. They don't work 100% of the time, but they are darn good. And you would be amazed if you incorporate these into your trading, just how often these key fib levels will work. And so use them in conjunction with things such as, when you rally into the fib, is there price resistance there as well, which in this case there is. Is there are there divergences, bullish or bearish divergences? And other things like that. So, but the point I'm trying to make here right now, bear market rallies. The only thing here, let me turn this off real quick. The only thing here that the strongest sector by far is XLE. Now, XLE is ripping. Number one, this doesn't help Powell and Company. That the fact that the energy sector is right off all-time highs. So far, unfortunately for Powell, to the bane of Powell and Company, energy is just not relenting. There's been a correction. Natural gas and crude prices are off the highs, but they're not falling as much as I'm sure Powell wants to see. Obviously, Russia is not helping things. Now Saudi Arabia isn't helping. The OPEC Plus cartel, which includes Russia, they said they're going to cut production. So, anywho, this doesn't help. But when we look at it from just a technical perspective, what I did here from that last leg down right here, this was the last major reaction high right here, and I put up the fibs. So I measured from this one down to that recent low right there, and then I put up, I turned on the, you go here to the tool. No, you go to this tool right here, click on your Fibonacci line, and I turned on the 127.2% retracement. So, believe it or not, it's just, you call it coincidence if you want. I don't make these lines. They're auto-populated. You just put them on the highs and the lows, and you can see we've retraced to that key 127% retracement there in XLE, the energy sector ETF. And again, that's the only one that's holding up, really. Everything else is solidly in bear market territory. Okay, since the most recent high right here, this is what you'd go off on XLU, utility sector. It was September 12th. We had a major peak right there in the utility stocks, so I took the fib from that level, started there, measured down to the recent low, and you can see we're not even all the way to the 38. This is just ugly bear market action. If we can't even, let's see if we even made it to the 23.6. Yeah, we're between the two. But so far, a pathetic rally. It hasn't even retraced a third, or about a third so far, but not to the 38.2 fib. Again, off that high there, and that was a peak. That was an all-time high because utilities are defensive sectors, and so they start going up when the economy is weak. But then they've just been taking it down. They've been taken down pretty hard lately. All right, next up, and then we are almost finished here. You have the REIT sector, and that's XLRE. There's your previous reaction high. It was mid-August, like a lot of the other sectors. And there's, I'm zeroing in right to the lows and to the button. You're, again, a weak retracement, 23.6. That's the minimum fib retracement level. And so far, that's what we hit. Just for fun, let's look at that reaction high and that one there. Well, obviously, they're going to come in lower. I mean, the numbers are higher because we have to drag the line up a lot more. So this is just ugly. This is real estate just getting killed, and hardly anybody stepping in to buy the bounce so far. And but the thing is, it's not going to move the needle as much in the S&P 500. It doesn't have the same weighting, but it does show what's going on in the economy. And then last but not least, XLB is basic material sector. That has the lowest weighting in the S&P 500. So there's your mid-August high. There's your lows. to the button, 50% Fibonacci retracement right now. That's where we're trading as of today. We hit it yesterday, couldn't get through there, closed right on it, and today tried again to get above, failed, and we're right below there if you can look closely and see it. All right, so that's it. And so the takeaway is, as of now, both cases can be made, and I think Apple and Amazon tonight, and almost certainly the Fed next Wednesday are going to make or break this setup. So you have a bullish setup with divergences and everything else. So far, all these sectors are off the lows. They are in short-term rally mode, and they're either going to build on these gains or this is going to prove, just like back in 2008, to be nothing more, even though you had the nice setup, bullish setup, that it's nothing more than a bear market rally. And that's when those bullish setups, like positive divergence on the daily and weekly charts, they almost always play out in a bull market. They do, and they're always the catalyst usually to the next highs and beyond. And in a bear market, sometimes they play out, and they do for a bear market rally. Heck, we already had one. We had about 12% so far. But some of the previous bear market rallies, are well into the 20% or more. So that's it. So we'll pick it up after today. And we'll see if Apple and Amazon give us some insight as to what this market's going to do. So what you want to look for going forward, obviously, just mainly on the major indexes and those stocks, look for a break of the recent lows. I'm going to just give you one example before I wrap up, and that was Meta. I told you Meta had just a perfect setup. The ball was 100% in the bear's court to take it and run with Meta into earnings. So why? Because this is a weekly chart. This was a major reaction low. There was a 44% correction right here from this divergent high, and it was priced in. You had negative divergence, big divergence. This is a weekly chart on Meta. You had a 44% drop. It came in. You had support right here, and it hit that level, and then the bull market resumed, right? We had fallen to that just the other day. I mentioned this covering the fangs. You had a similar setup to the stock market. You had positive divergence here on the weekly chart. At that point, you had a nice downtrend line in which to trigger a breakout above, and you were at long-term support. So by all metrics, that was a beautiful setup for Meta. But what happened? See, in a bear market, this is what happens. Those bullish setups just fail to materialize, and the thing got the snot whacked out of it. And so that's where it's at. Daily chart too, you had the there was your positive divergence. Look at that, strong. You had trend line, downtrend lines, a lot of things that could have played out, but it didn't. It went this way. So this is what we're going to see if Apple and Amazon can build. Just because these guys went down doesn't mean that Apple and Amazon must, but the chances of a earnings miss and a big disappointment and bad guidance is a lot higher in the current market environment we're in. We're seeing a deterioration. We're seeing there's bulls have had all this hopes because a lot of companies' earnings have held up, and a lot of companies were able to raise prices in this inflationary environment that helped their bottom line, but we're a trend. We're seeing a trend. The market's economy's slowly rolling over. I always talk about that. The economy, it's like a super tanker or aircraft carrier at sea. It doesn't turn on a dime like a speedboat. It makes slow turns, slow roll, and so far that's what's been rolling. And tech is usually, or high growth companies are usually the first to go. All right, guys, I'm going to wrap it up here. Let's just watch and see what happens after today, and then again, do your own thing, but don't be married to any one bias right now, bullish or bearish. Just react. Let's see what the market tells us tomorrow after the close today. Don't read too much into the initial reaction unless it really bangs up, takes out some key support or key resistance levels. Even then, take it with a grain of salt, the initial reactions, because remember, they always follow up with a conference call, and then that's still the after-hour section where the big institutions can't maneuver as effectively, so they will decide whether to buy or start selling tomorrow when the market opens. So you're probably not going to have a good idea until tomorrow, but of course tomorrow's Friday, then you got a weekend to head into, and then the big Fed ahead. So it's a good time to keep it light for now, and we can always layer in as the market starts to show us its hand over the next about 4 or 5 trading sessions. This has been Randy Finney with the right side of the chart. Hope you enjoyed it.